Hello, welcome to Capital Sensei. Today we're diving deep into the mind of a true investing legend, Thomas Rowe Price Jr. We'll unpack his revolutionary approach to finding growth stocks, those companies that can multiply your investment over time. We'll cover his core principles, the specific traits he looked for in a winning company, how he knew when to buy, and just as importantly, when to sell. This is the blueprint from the man often called the father of growth investing. As we go, we do our best to answer questions and read your stories in the comments section. So if you have a question about growth investing, or maybe you've tried it yourself and have a story to tell, please share it below. Your experience helps everyone in our community learn and grow together. All right, let's talk about Rowe Price Jr. To really get what he was all about, you need to understand the world he came from. He started his firm, Rowe Price and Associates, in 1937. Think about that timing. The world was still digging itself out of the Great Depression. Most investors were terrified, and the dominant philosophy, championed by the great Benjamin Graham, was to buy stocks that were dirt cheap, so-called cigar butt companies that had one last puff of value in them. Price looked at this and thought, there has to be a better way. Instead of rummaging through the bargain bin for damaged goods, why not identify the best companies in the world and just own them? Why not bet on the champions of tomorrow instead of the forgotten relics of yesterday? He wasn't interested in a quick puff. He wanted to buy into a business that could grow its earnings and value for years, even decades. This was a radical idea at the time, and it laid the foundation for what we now call growth investing. His first and most fundamental principle was to focus on the long term, and I mean really long term. He wasn't interested in what a stock would do next week or next quarter. He was thinking 5, 10, even 20 years down the road. This is a complete mental shift from how many people approach the market today, where they're glued to the screen, panicking over every little dip and headline. Imagine you're planting a tree. You could plant a radish, which sprouts in a few weeks. You get a quick, small reward. Or you could plant an oak sapling. For the first few years, it might not look like much. It will face storms, droughts, and seasons of slow growth. Someone focused on the short term would get impatient and dig it up. But if you have the patience to let it grow for decades, you end up with something massive, strong, and incredibly valuable. Price was in the business of planting oak trees in his portfolio. So, if you're going to bet on a company for a decade, what exactly are you looking for? This brings us to Price's checklist for identifying these long-term winners. He wasn't just throwing darts at a board. He had a very specific set of criteria. And the first one was what he called superior management. For him, a company was only as good as the people running it. This went way beyond just looking at a resume. He wanted to see visionary leaders, people who didn't just manage the day-to-day, but had a clear, compelling vision for where the company was going in the next 10 years. He also looked for integrity. Are they honest with shareholders? Do they admit their mistakes? And crucially, do they have skin in the game? Price wanted to see executives who owned a significant amount of their company's stock. It aligns their interests with yours, the shareholder. Think of it like this. You wouldn't get on a cruise ship if the captain had a reputation for being a terrible navigator and had their own personal helicopter ready to flee at the first sign of a storm. You want a skilled captain who has a map, a destination, and has their own family on board. If the ship goes down, they go down with it. That's the kind of commitment Price looked for in a company's leadership. Next on his list was the industry itself. A great company in a dying industry is like the world's most luxurious horse-drawn carriage manufacturer in the 1920s. It doesn't matter how well crafted the carriage is. The world has moved on to the automobile. Price understood that a company needs a powerful tailwind from its industry to achieve spectacular growth. The whole sector should be expanding. He was looking for companies riding big, secular waves of change. In his time, that might have been the rise of consumer brands, new technologies like air conditioning, or advancements in pharmaceuticals. Today, those waves might be things like artificial intelligence, cloud computing, genetic engineering, or the transition to renewable energy. The key is to find a business that's not just swimming, but being pushed forward by a strong current. It makes everything easier, but being in a great industry isn't enough. You could have 10 companies all trying to build electric cars. What makes one a better investment than another? This leads to Price's third crucial element, a sustainable competitive advantage. This is a fancy term for asking a simple question. What makes this company special? What can they do that their competitors can't easily copy? Economists and investors often call this a moat, like the ditch filled with water around a medieval castle. It protects the castle, the company's profits, from invaders, which are the competitors. Price was obsessed with finding companies with wide, deep moats. These moats can come in many forms. It could be a powerful brand, like Coca-Cola or Apple, that people trust and are willing to pay more for. It could be a secret recipe or a patent, like the formula for a blockbuster drug. It could also be high switching costs. Think about your bank. Moving all your automatic payments and direct deposits to a new bank is a huge hassle, right? That hassle is a switching cost that protects your current bank from losing you as a customer. Or it could be a network effect, where the product becomes more valuable as more people use it, like Facebook or Visa. The wider and deeper the moat, the safer the company's future profits. Okay, so we have great management, a growing industry, and a protective moat. What's next? Price dove into the numbers. He specifically looked for companies with a high return on capital and a strong commitment to research and development, or R&D. Now, return on capital might sound a bit technical, but the idea is simple. It measures how good a company is at turning money into more money. Imagine two coffee shop owners. They each spend $100,000 to open a new shop. Owner A's shop generates $20,000 in profit in its first year. That's a 20% return on capital. Owner B's shop only makes $5,000 in profit. That's a 5% return. Which business would you rather own? Obviously, Owner A's. Price looked for those Owner A companies that were incredibly efficient at reinvesting their earnings to generate even more growth. And that ties directly into research and development. Price saw R&D as a company planting seeds for its future. A business that isn't investing in new products, better technology, and more efficient processes is essentially eating its seed corn. It might look more profitable in the short term because its expenses are lower, but eventually, its products will become outdated, and its competitors will race past it. He wanted companies that were constantly innovating, ensuring they would still be leaders years from now. So let's recap Price's shopping list. You're looking for a company with visionary management that has skin in the game. It's operating in an industry with a powerful long-term tailwind. It's protected by a wide moat, like a strong brand or unique technology. And it's excellent at turning profits into more profits, while also investing heavily in its future. If you find a company that checks all these boxes, you've likely found a potential long-term winner. But this brings us to a really important and often misunderstood part of Price's philosophy: valuation. At what price do you buy this wonderful company? A common mistake is to think that because he was a growth investor, he was willing to pay any price for growth. That's not true at all. He was very disciplined about the price he paid. He wasn't a cheapskate like a deep value investor, but he certainly wasn't a fool. He understood that a great company growing its profits by 30% per year deserves to trade at a higher valuation multiple, like a higher price-to-earnings ratio than a boring company growing at 3%. You're paying a premium for that future growth. The question is, how much of a premium is reasonable? Think about buying a house. A beautiful, well-built house in a rapidly growing, desirable neighborhood is going to cost more than a rundown shack in a declining town. That makes sense. You're willing to pay a premium for quality and location. But even for that beautiful house, there's a price that's just too high. A price that becomes speculative and foolish. Price was always trying to find that sweet spot, buying a wonderful company at a fair, or what he called a reasonable price. He'd happily leave a great company on the shelf if the market had bid its price up to irrational levels. To better understand this, Price developed a mental model of a growth stock's life cycle. He saw companies moving through distinct stages, and knowing which stage a company was in was critical to his investment decision. He didn't want to buy too early when the risk was astronomical, or too late when the best growth was already in the past. The first stage is what you might call early growth. This is the startup phase. The company is small, often unprofitable, and trying to prove its concept in a new or emerging industry. The risk here is enormous. Most companies in this stage fail, but for the few that succeed, the returns can be astronomical. Price was generally cautious here, preferring to wait for a bit more proof. The second stage, rapid expansion, was his sweet spot. This is where the company has a proven product, a working business model, and is now scaling up as fast as it can. Sales and profits are exploding. The market is starting to recognize its potential. Think of Amazon in the early 2000s or Netflix when it first started streaming. The risk is lower than in the startup phase, but the growth potential is still immense. This is often the best time to get on board. The third stage is mature growth. The company is now a dominant leader in its industry. Think of a company like Microsoft or Visa today. Growth has slowed from the explosive rates of the second stage, but it's still growing faster than the overall economy. It's a highly profitable, stable blue-chip company. Price was happy to hold his winners through this stage, as they became the solid foundations of his portfolio. Finally, there's the fourth stage, decline. The company's industry has become saturated. Or worse, it's being disrupted by a new technology or business model. Growth stalls and then begins to shrink. Think of Kodak with the rise of digital cameras, or Blockbuster with the rise of streaming. For Price, recognizing this stage was the signal to sell and move on, no matter how much he loved the company in the past. There was no room for nostalgia in his process. This life cycle framework is incredibly powerful because it adds a time dimension to the analysis. It's not just about whether a company is good or bad in a static sense. It's about where it is on its journey. The goal was to buy in stage 2, hold through stage 3, and sell before stage 4 really took hold. Selling was just as important as buying. You have to be disciplined enough to part with a company once its best days are behind it. Let's try to put this all together with a hypothetical example. Imagine a new company, let's call it SolarSkin, that has developed a revolutionary paint-like material that can be applied to any surface and generate solar power. How would we analyze this through the Rowe Price Jr. lens? First, management. Is the CEO a brilliant material scientist with a clear vision for making every building energy independent? Does she own 20% of the company? Check. Second, industry. Is the world shifting toward renewable energy? Is there a massive, growing demand for decentralized power generation? Absolutely. Huge tailwind. Check. Third, the moat. Does SolarSkin have strong patents on its formula that would take a competitor years and millions of dollars to replicate? Is the brand becoming known for quality and reliability? Let's say yes. Check. Fourth, the numbers. Is the company reinvesting every dollar of profit into building new factories and improving the formula? Is its return on capital a stunning 30%? Check. Now, the life cycle and valuation. SolarSkin has just moved past its startup phase and is now in rapid expansion. Orders are flooding in. This is price's sweet spot. But what's the price? The market is excited, and the stock is not cheap by traditional metrics. A value investor might run away screaming, but Price would say, given this incredible growth profile and durable competitive advantages, is this price reasonable for what this company could become in 10 years? If the answer is yes, he would buy. This process highlights the fundamental difference between growth and value investing. They are two different paths up the same mountain of financial success. The value investor, like Ben Graham, is a bargain hunter. They go to a corporate garage sale, looking for a forgotten antique, a company trading for less than its assets are worth. They want to buy a dollar's worth of business for 50 cents. It's a statistical, quantitative approach. The growth investor, like Rowe Price Jr., is more like a venture capitalist for the public markets. They are trying to identify the next great innovator. They're looking for a dollar that, through growth and compounding, can become $10 or even $100 over the next decade. And they are willing to pay a fair price, maybe even $1.10 today, for that potential. It's a qualitative, forward-looking approach focused on the business's future potential, not just its current assets. This brings us to a crucial, often overlooked aspect of this strategy: the psychological fortitude it requires. Growth investing is not for the faint of heart. The very nature of fast-growing, innovative companies means their stock prices are often incredibly volatile. A stock that can go up tenfold over a decade can easily drop 30, 40, or even 50% in a single bad year or a market panic. If you don't truly understand the business and have conviction in its long-term story, you will panic and sell at the bottom. That's the kiss of death for a growth investor. The whole philosophy is predicated on holding through these terrifying drawdowns. In fact, for a true price disciple, a big price drop in a great company, where the business itself is still doing fine, is a gift. It's an opportunity to buy more of that wonderful business at a more reasonable price. It's like being an early passenger on a rocket ship. The launch is going to be violent, shaky, and loud. It will feel like everything is about to fall apart. Most people would scream to be let off. But if you can stomach the launch and trust the engineering, you eventually break through the atmosphere into the calm of space, and the view is spectacular. Price's strategy requires the emotional toughness to stay strapped in during that violent launch phase. This is why his emphasis on deep research is so critical. Your conviction doesn't come from a hot tip or a news article. It comes from having done the hard work yourself. It comes from understanding the management, the industry, the moat, and the financials so well that when the market panics, you see an opportunity while others only see fear. You know the quality of what you own. So, in essence, the Rowe Price Jr. method is a disciplined, research-intensive quest to become a long-term part owner of the world's most dynamic and innovative businesses. It's about finding that rare combination of superior management, a favorable industry, a durable competitive advantage, and excellent financial characteristics. It's also about having the wisdom to pay a fair price for that quality, and the patience and emotional strength to hold on for the long ride. through all the inevitable bumps and storms along the way. It's not a get-rich-quick scheme. It's a philosophy for building lasting wealth by identifying and partnering with the great enterprises of our time. It requires work, it requires patience, and it requires a mindset focused on the distant horizon, not the waves crashing at your feet. But as his legendary track record shows, the rewards for those who master it can be truly extraordinary.